All right. So sorry to keep everybody waiting. A warm welcome to everybody for joining the UK-Japan Transition Finance Forum 2026, organized by FinCity Tokyo and co-hosted by the GX Acceleration Agency with special support by Nomura and the City UK. We have a rather packed program ahead of us today, in which we will explore the topic of transition finance from a variety of angles. We do kindly ask everybody to set your mobile phones to silent mode before we begin. And without any further ado, I'd like to hand over to Mr. Shogo Ohira, Vice Chairman of Nomura Europe Holdings, for some opening remarks. So please go ahead.
Thank you very much. Hello, everyone. Konnichiwa, minasama. Thank you very much for your joining us for the UK-Japan Transition Finance Forum 2026. My name is Shogo Ohira, Vice Chairman of Nomura Europe. It's a great pleasure to welcome you and welcome to Nomura. Really great to see big audience in the venue, and I'm so happy. We are very grateful to collaborate with the FinCity Tokyo, the GX Acceleration Agency, and the City UK. As you might know, Nomura Group recently celebrated our 100-year anniversary, and we have further strengthened our efforts for our group purpose. We are committed to creating a better world and a sustainable society through the power of financial markets. So sustainability and transition finance are definitely key agenda to us. And Nomura Group have been here in UK for more than 60 years and connecting East and West, connecting UK and Japan. This is our key strength and key passion, key mission. So it's great privilege for us to support a dialogue between UK and Japan on this important theme, transition finance. We are really honored to have distinguished speaker in the forum. I'm confident that the discussion will be insightful and productive, and I'm sure you will enjoy good discussion. So thank you very much again for being here, and please enjoy.
Thank you, Ohira-san. So next, I'd like to welcome to the stage Mr. Tokyo Morita, Executive Director of FinCity Tokyo, and Dr. Dai Yamawaki, Vice President Equities of Nomura Asset Management UK. Yes. We shall move on to the second block in our agenda, which is the Fireside Chat between these two gentlemen, Mr. Morita and Mr. Yamawaki. So just to set the background, I'd like to ask both of you this question. So just to set the background, how do you see the evolution of Japan's financial market over the past few years? Why is Japan now back on global investors' radar? So I'd like to start with you, Morita-san, for that question.
Thank you. And first of all, thank you very much for coming to this event, and thank you very much for having me. Well, it may be too warm to say, call it Fireside Chat, but let me try to answer many questions. Yes, I would like to say that Japanese capital market is evolving fast. Nikkei index is doubled for the past 2 years, but I would like to say it's not just the sort of issue of the stock prices, but more fundamental structural change is going on. You may have heard Asset Management Nation Initiative started by the Prime Minister Kishida, and now Takaichi administration is also taking the lead as well. The issue is that we have to deal with the whole investment chain, starting from the household, distributor, asset management companies, and asset owners, and investee companies. So you may be tired of hearing this, but we have the sort of $7 trillion dormant deposit and cash of the household, which should be directed into this investment. Now we have introduced the NISA account system, which is a generous tax incentive mechanism, but under which the current outstanding is 70 trillion yen, which is equivalent to the 6% of the Tokyo Stock Exchange capitalization. Also, we have introduced the Stewardship Code and Corporate Governance Code, which have fundamentally changed the nature of the discussion about the board of directors level of the companies. In the past, the board had just been discussing the sort of operational issue approval. But now they have started discussing the sort of growth strategy and capital efficiency. And Tokyo Stock Exchange recently required the companies with low trade, their stock is trading below the sort of book value to disclose the specific plan to enhance capital efficiency. And that kind of set of visible benchmark will lead to the sort of strong pressure from the analysts, investors, and peers. And also, unwinding of cross-shareholding is enhancing the sort of market discipline. That will lead to the Japanese company to seek for longer-term value creation. That is behind the stock price hike of the Nikkei index. And so I would like to say that that's not the only issue of price, but Japanese capital market is experience fundamental structure changes. Thank you.
So Yamawaki-san, your perspective on this, please?
Okay, yeah, thank you very much. Thank you very much for having me today. And yes, actually, we are seeing unprecedented level of global investors' interest in Japanese market right now. And of course, there are several factors behind that, for example, AI and semiconductor supply chain. So some Japanese players are well involved in these sessions. And also, now I'm currently actually 36 years old, and most of my life are actually deflationary environment. However, now it's changing right now, so we can see inflations and wage growth as well. However, if we look at only recent stock price movement or AI-related topics, so we might miss the big pictures on what's going on in Japanese economy right now and what's the key differences between the past. So for example, let me bring back to you 2013. So when the economics, Abenomics started, its rally started, and it was with monetary easing, yen depreciations, and also, I think 3 years later, we had corporate governance code, right? Back to 2016. At the time, just like now, foreign capital came into Japanese market at the same level. However, to my mind, that in terms of the change of behaviors of Japanese companies are like superficial or pseudo in nature. So actually, Japanese companies, they had excess cash in their balance sheet, so they are really cash-rich companies with low capital efficiencies. So that is why they are traded, as Morita-san, you said, they are traded well below the book values. So this is like past-dependent characteristics from the 1990s. So, however, current ongoing re-evaluations of Japanese market. So starting since 2023, so it's actually, as Morita-san, you mentioned, so it's Tokyo Stock Exchange's call for actions to implement management that is conscious of cost of capital and also stock prices. To my mind, this is critical juncture in political economy science, right? So after these policies, now the changes of Japanese companies' behavior is ongoing. So they are doing more frequent buyback, and also they are selling cross-shareholding, so they are emphasizing so ROE and ROIC in their management, and also they are reviewing their capital allocations, and they are doing proactive engagement with shareholders. So this kind of, as Morita-san says, fundamental changes are really attractive to global investors. And now, we discussed, so global investors' radars. Now Japanese companies are within global investors' radars. Now, what's next? So what's the implications? So first of thing, disclosure side. So now Japanese companies are required more detailed analysis and information disclosures. So let's take example of climate change. So nowadays, global asset owners, global asset managers, so they are not simply like asking, do you have a net zero commitment? No. Rather, they are very curious to know, so how you will get there to be net zeros. So most of Japanese companies, so they are required like more details, informations on their capex for GX, and also commitment, accountability by management, and also this kind of process should be verified by third parties. And one last point is regarding engagement. So now the number of engagement by global investor to Japanese company is actually increasing, and it's more increasing going forward. And however, there were several issues like differences in management customs, qualities, and also way of communications. It can often lead to misaligned communications between global investors and Japanese investors. So both sides are ended up frustrated, exhausted. So it's totally negative sum game, right? So in this sense, in my opinion, so it is we, Japanese asset managers, that is serving as lead investors to facilitate dialogue for positive engagement outcome. So this is my opinion.
Well, thank you very much for that. So looking at Japan as it is right now politically, the Takaichi administration advocates a responsible, quote unquote, responsible, active, proactive fiscal policy to mobilize more capital towards growth. So how do you see the current administration's policy, and where is it headed? Starting with Morita-san here, please.
Thank you very much for your question. Yes, Takaichi's administration is advocating the sort of responsible, proactive fiscal policy. But this is not just a one-time fiscal stimulus, but it is going to deal with massive economic structural change. Prime Minister Takaichi thinks that what is the major core issue of the Japanese economy? That is under-investment for growth strategy and crisis management investment. So she identified 17 priority areas for investment, and now the government and also private sector get together to identify more specifically the targets areas with potential growth, future growth. For example, and green transformation is still one of the 17 priorities. So for example, green steel, green chemical, hydrogen, and power generation, ammonia, all are being targeted and identified for the target areas of future investment. So this is what they are doing. But the private sector would think that if the government says that this is the priorities and the private sector should also invest, this is sometimes a high-risk areas. So more longer-term commitment by the government may be required to give the assurance to the private sectors for further investments. That will lead to the idea of multi-year budgeting. If we are just focusing on the sort of 1-year primary balance budget restraint, that will not give private sector the sort of enough assurance. But if you commit to the multi-year budgeting, and if we commit the sort of medium-term investment by the government, that will give you the assurance. So that is the idea of the sort of responsible, proactive fiscal policy. That is not related to the irresponsible sort of budget control. Maybe currently how to conduct the sort of this policy is still under the discussion. But one idea may be that we are not concentrating on the sort of 1-year primary balance budget, but also we will also see the sort of total government outstanding in terms of the nominal GDP should be under control. And we will also monitor the market like CDS or interest rate development. And as we will monitor the sort of fiscal situation in a more comprehensive manner to ensure the sort of medium to long-term fiscal sort of sustainability. That is the idea of the Takaichi administration.
Thank you very much for that. So, Yamawaki-san, how has London financial markets and internationally as well, how have they received Prime Minister Takaichi's policies?
Yeah, well, first of all, I totally agree what Morita-san said. So it should be responsible. Otherwise, we will losing, market credibilities, right? So please let me sort out, because this is a little bit complicated. So from equity side and also fixed income side. So starting from equity side. So basically, equity investors are generally positive for Takaichi's administrations and its fiscal policy because expanding policy. So please remember macroeconomic equations. So this is capital, investment, right? Domestic capital investment. So that's boost some industries. And as Morita-san said, also, so we have in the short term, so some industry can benefit from its expanding policies like AI, semiconductors, infrastructures. However, if, long-term interest rise, so in this case, so it's almost like, I can say, it is headwind for most of industries except financials, right? Especially, high dividend or defensive sectors and also utility sectors are likely to be facing a more challenging market environment if long-term interest rise. And also, when it comes to fixed income investors, so they are more careful about this because when it comes to, fiscal agendas on the table of Japan, so it's not simply like strategic investment. Rather, we have also like measures suspending consumption tax on food, and also we need more budget for defense sectors, right? So that is why they are very curious to know, or careful to know, so how much will be the impact on Japanese government bond and interest rate? And especially when it comes to UK-based fixed income investors, so they are more, I think it's my opinion, so they have more strict view on fiscal discipline because they have experiences. So back to 2022, so it's mini budget and trust shock, right? So they are more strict view, I think. And also, it's to my mind, so Sanaenomics is more like the policy that is aiming not to rush toward or like primary balance surplus, rather to stabilize debt to GDP ratios. So this practice is actually put in practice what Dr. Olivier Blanchard, he actually pointed out back to 2019 American Economic Association's lectures. So this is if the nominal GDP growth rate exceeds interest rate, so the debt to GDP ratios will not be likely to be deteriorated, right? If the government is running at the massive scale of primary balance deficit. So this is my opinions. And also maybe it's better for us to discuss about GX in this context. So most of GX investment, so whichever you want, so like hydrogen, ammonia, CCS, what else, offshore wind, and also battery storage. they really requires upfront investment at a larger scale, right? And their investment duration is also long before payback. So that is why if the long-term interest rise, so it's equivalent to higher discount rate, so which may erode the net present value of GX product and also discourage investment appetite in the market. So this point are a little bit risky, I think. However, this kind of discussions all depends on where technology goes. So a small part of GX technologies and breakthrough innovations, they can completely change the model equations. So if we are discussing about GX investment, at the time we have to think about both sides. Both markets need to be tracked, so financial side and also what's going on in GX technology front.
Very interesting. Thank you so much. So I wanted to stay with you there, Yamawaki-san, for our final question, which is actually the same question for both of you. But how can London and Tokyo best collaborate as finance hubs going forward to channel finance into sustainable development?
Okay. It's my opinion, but London's strength is very straightforward. So it's an accumulation of international capital, right? So most of asset owners, asset managers, other financials, so they are gathering in London right now. And when it comes to Japan's strengths, Tokyo's strengths, so this is like distinctive characteristic compared with London. So this is proximity to real economies. So as we discussed so far about GX, however, so it is Tokyo that is a home to most of technologies and companies that actually drive energy transitions. So in this sense, I think that one of the greatest potential areas for further collaborations is to support developing economies to make transitions, right? As you know, developing economy, for them, actually, energy access is also a critical agenda item as decarbonizations. So what they are really needed is, it's not green finance, it's green taxonomy. It's not green taxonomies. So they are really needed, it's transition finance to change and transform their work and also their daily life. So in this sense, yes, one interesting point, and sorry, I'm not deep diving because this topic will be discussed later this session, right? However, one thing for sure, so collaborations between two cities, or maybe we can say bricolage of these kinds of two strengths can boost further collaborations, actually further energy transition in developing economies. So one example is actually, last week, Tokyo-based JICA and also London-based BII, they signed a memorandum of agreement, actually MOU, and on further collaborations for co-finance and private sector mobilizations. So that is why this kind of cooperation is really encouraged.
Thank you very much for that. So, Morita-san, same question for you then. How can London and Tokyo best collaborate as finance hubs?
Thank you very much. Actually, I am an ex-regulator, and I always think that UK is our big brother in a sense that UK and Japan also both think that the financial industry is very important and the core of the sort of national economy. And actually, we are doing the very similar things. In the UK, you have introduced the ISA tax incentive scheme. We have introduced NISA. In mid-2010s, 2016 or 15, FCA conducted the sort of distributors review, and we have also made the sort of put the sort of customer first principle to the distributors. And in 2016, FCA also conducted the asset management market review. We are now promoting the sort of sophistication of the asset management services. And you have introduced stewardship and corporate governance code. We followed that kind of policies. So we are doing the very similar thing and in a very similar directions. So we can be a sort of natural collaborator. And UK has, as Yamawaki-san said, very deep global investor base, and the UK has a culture of financial innovation. And I always respect the UK's ability to set the international global standard. For Japan, we have the very industrial technologies for hard-to-abate sectors as well. And we are the only Asian country of the G7s. So we can be a bridge between the sort of state-of-art G7 countries' policies and sort of Asian emerging country colleagues' reality. So there are a lot of scope for collaborating together. And finally, in terms of the green transformation, UK and Japan has a similar mindset of being realistic and pragmatic. So in that sense, I think that we can work together, especially in the transition finance area, as Yamawaki-san suggested. Thank you.
All right. Thank you, both of you, so much for your insights and comments. Thank you very much. So a round of applause for the two speakers. Thank you. So, moving on to our next point of the agenda here. We will hear from Ms. Takako Onitsuka, who is the director of the Environmental Finance Office at METI, who will give us an overview of Japan's climate transition goals, transition bonds. Sorry. You have a clicker here for the slides. There you go.
Thank you very much for your introduction. It is my great honor to be invited here. And my name is Takako Onitsuka. I'm in charge of environmental finance in the Ministry of Economy, Trade and Industry of Japan. As was discussed in the previous Fireside Chat, under the Takaichi administration, Japan is strongly promoting policies to stimulate economic growth by attracting investment from around the world. In this context, today, I would like to outline Japan's GX, green transformation policies and transition finance. There are 3 points I would like to highlight today. First, why GX matters now. And second, GX policy and climate transition bond. And third, the growing market transition finance. Let me begin with why GX matters now. So Japan's green transformation aims to achieve 3 goals simultaneously. First, emission reduction or decarbonization. Second, energy security. And third, economic growth. We see the significance of such approach has been growing recently. First, we see the importance of the key for energy. GX is a key for energy security. As is shown in this chart, the share of fossil fuels in primary energy supply remains very high in many countries, and including Japan at around 80%. Moreover, growing instability in the Middle East has increased energy security risks given the concentration of energy import sources. So reducing dependence on fossil fuels is essential not only for emission reduction, but also from the perspective of energy security, which highlights the growing importance of GX. Next, we see GX as a key for energy addition. Driven by the global surge in electricity demand from AI and data centers, energy addition, the expansion of supply capacity has also emerged as a key global challenge. The IEA's latest World Energy Outlook stressed that beyond decarbonization, balancing supply capacity with economic growth has become a pressing global challenge. Japan's GX policy originated from the 2050 carbon neutrality declaration in 2020. The GX Basic Policy, the GX Promotion Act, and the GX 2040 vision constitute the core frameworks of Japan's GX policy. Based on this framework, Japan is advancing GX policies with strong emphasis on policy consistency and predictability for both domestic and international investors and businesses. So, how do we promote GX investment? We have been developing institutional measures from both regulatory and support perspectives. This chart illustrates how we structure the system. First, the government of Japan issues GX economy transition bonds up to approximately 20 trillion Japanese yen over the decade to provide upfront investment support. Then we gradually introduce carbon pricing, which aims to create incentives for companies to invest early in GX. As for carbon pricing, a full-scale emission trading system, ETS, was launched this April with free allocation. And allowance auctioning will start from fiscal year 2033. And furthermore, the GX surcharge on fossil fuel supply will be introduced from fiscal year 2028. Revenues from these carbon pricing measures will serve as a source of redemption for GX economy transition bonds. Financial support through public-private partnership is an essential part of the GX policy. Transition finance through blended finance plays an important role. Through these integrated measures, we aim to mobilize 150 trillion Japanese yen capital in public and private investment in GX. To mobilize capital for decarbonization, we believe that the transition finance is key. Achieving economy-wide transition or decarbonization requires more than green investment alone. It is essential to support the transition of high-emitting and hard-to-abate sectors. So Japan takes a four-step approach to encourage the flow of private finance for transition. First, we established a basic guideline on climate transition finance aligned with ICMA's Climate Transition Finance Handbook, with concept that can also be applied to loans. The second approach is a sectoral roadmap to present concrete transition pathways toward achieving carbon neutrality by 2050 in high-emitting or hard-to-abate sectors. These roadmaps are updated periodically, reflecting technological progress and changes in market conditions. Furthermore, we have promoted model projects with some financial support to accumulate best practices of transition finance, and also developed guidance on financial emission and engagement. In February 2024, Japan issued the world's first sovereign transition bonds called Japan Climate Transition Bonds. The bond framework was established in November 2023, and alignment with ICMA's Climate Transition Bond Guideline was confirmed through second-party opinion this year. Japan published the first impact report in January this year to enhance transparency and accountability. The report provides quantitative value for both emission reductions and economic impacts for each project. Under this framework, Japan plans to issue 1 trillion Japanese yen in climate transition bond in fiscal year 2026. And last month, we issued approximately 250 billion Japanese yen climate transition bond, and very much welcomed by the market. We very much look forward to the active participation of all of you here in this market. Supported by these domestic frameworks and the sovereign issuance of transition bond, the transition finance market in Japan's private sector has been growing. While the power sector accounts for the largest share, there is also growing uptake of transition finance across a wide range of industries, including iron, steel, chemicals, shipping, and pulp and paper. We expect this market to continue expanding further going forward. Next, I would like to highlight prioritized areas under the GX policy framework, which is also the use of proceeds of climate transition bond. In promoting GX, we identified 16 priority areas, including materials, final products, and key components and clean energy. Accordingly, 16 sectoral investment strategies have been made, and the government's investment support is aligned with these strategies. Under the forthcoming Japan's growth strategy of Takaichi administration, 7 specific sectors have been identified as key products and technologies in GX field, as is shown in the right-hand side of this slide. In addition to supporting individual companies, Japan has also strengthened GX initiatives at regional level. Specifically, we launched GX Strategic Zone Initiative last year. Regions are selected under 3 categories. First, revitalize industrial clusters. Second, data center clusters. And third, decarbonized industrial parks, leveraging clean power sources. Selected regions will be provided with integrated regulatory reforms and financial support. We have already received applications from more than 100 municipalities and regions across Japan, and the final designation are expected in this summer. Recently, the need and interest towards transition and its finance has been growing internationally. Japan, as a country proactively advancing transition finance, will continue to contribute to the development of the global transition finance market, including in Asia. In conclusion, Government of Japan is committed to advance GX policies and play an active role in supporting the global transition to address the challenges the world faces. We sincerely hope for your continued and active investment in the growing GX market, both from Japan, from the UK, and from abroad. Thank you.
Thank you very much for that. So next, I'd like to welcome Ms. Kanae Iomori, who is the director of the GX Acceleration Agency. She will explain to us how the GX Acceleration Agency approaches blended finance. So Iomori-san, please have a clicker there for your slides.
Thank you. Good afternoon, everyone. Thank you for this opportunity to speak to you today. My name is Kanae Iomori, and I'm a director and head of credit at the GX Acceleration Agency, or GXA, in Japan. Okay, as Onitsuka-san has covered, GX stands for Green Transformation, and the GX initiatives aim to achieve three pillars: stable energy supply, economic growth, and decarbonization. Just to briefly explain who we are, GXA was established in 2024 under the GX Promotion Act. GXA serves as the implementing body, translating GX policies into concrete actions on the ground. So there's 3 pillars that, in terms of the activities that GXA undertakes, which is number 1 is to provide financial support, 2, administer the new emissions trading system, and 3, act as a GX hub to promote research, stakeholder collaboration, policy discussions, and international communications on GX and sustainability. Let me now briefly set the context for Japan and the broader Asian region. Both face common structural challenges in the transition, high dependence on imported fossil fuels, and significant emissions from energy-intensive industries, such as steel, chemicals, and power generation. Across both contexts, we see shared issues: high technological uncertainty, limited investment visibility, and a strong need for scale to achieve profitability. Ultimately, this transition is not just about technology. It is fundamentally an investment and system-level challenge. Against this backdrop, Japan has developed a system-level approach to the transition. At its core, this approach integrates three key elements: policy, technology, and finance, aligning them in a mutually reinforcing way rather than treating them separately. The government provides long-term direction, policy credibility, and investment-oriented roadmaps. Industry is responsible for making investment decisions, deploying technologies, and executing projects. And financial markets play the critical role of allocating capital and enabling scale. Together, this creates a model that is government-enabled, industry-delivered, and market-financed. Importantly, Japan also combines sector-specific technology roadmaps with transition finance frameworks. This helps provide both clear direction and credibility, two essential conditions for mobilizing private capital at scale. A key pillar of the system is the development of transition finance. This topic has already been covered by Onitsuka-san. Just a quick note, transition finance in Japan is not just where the money goes, it's about whether a company's overall transition strategy is credible and implementable. So I'd just like to cover that even with these frameworks in place, significant bottlenecks still remain. The key issue is that the private sector alone cannot deliver transition at the required speed and scale. This is fundamentally a problem of bankability. Many transition projects face multiple layers of uncertainty, such as technology risks, commercialization uncertainty, and performance uncertainty. But even more critically, there is revenue uncertainty, the absence of long-term offtake, and uncertainty around cost pass-through. In addition, there are system-level constraints, such as underdeveloped supply chains and infrastructure uncertainty. And then on top of that, there's execution challenges, such as scale-up risks and capability gaps. Taken together, these risks are difficult for private capital to price and absorb on its own. As a result, even projects that are socially desirable do not necessarily become investable. This is precisely where GXA comes in. GXA's core function is to complement risks that cannot be fully borne by the private sector. GXA is designed to add value in several ways. First, through risk mitigation and risk sharing, improving the bankability of projects. Second, by ensuring policy alignment and credibility, which is critical for investor confidence. Third, by catalyzing private capital, what we often call the crowding in effect. And fourth, by supporting financial innovation and market development, including expanding the investor base. In terms of financial instruments, GXA provides debt guarantees to project finance and transition finance, and equity investment from startups to large-scale projects. By taking on long-term and structural risks, GXA helps enable financing that would otherwise not take place. Now, it's equally important how projects are selected and evaluated. GXA conducts its own credit and/or investment evaluation based on comprehensive criteria. This includes financial sustainability, but also broader social and economic impact, particularly in relation to GX. Importantly, GXA aims to support projects where full repayment is expected from future cash flows based on GXA's evaluation, while also ensuring that projects deliver meaningful transition impact. External expert input is also incorporated in our due diligence to ensure transparency and objectivity. In short, GXA is designed to ensure that both financial discipline and policy objectives are met simultaneously. So recently, we have approved and executed 4 debt guarantees as well as 1 equity investment. And it's not on this slide yet, but 2 equity investment deals have been approved and will be published hopefully soon. So here, the debt guarantee projects are based on transition finance. You can see one is around green steel, one is ammonia production using recycled plastics. The other 2 is supporting decarbonized power sources. So these are our recent track records, but this is not enough. We want to follow up with the pipelines we have on our list. So let me now briefly turn to the international perspective. Many emerging economies face challenges that are similar to Japan's, such as energy dependence, ongoing industrialization, limited fiscal space, and high investment risks. In this context, Japan's model may offer useful references. It's not just capital, but a framework for structuring investment. This includes, for instance, risk allocation, defining and mitigating risks to achieve bankability, financing structures, aligning risk return with investor requirements, project development, moving projects to an investable stage, coordination mechanism, aligning policy, industry, and finance. Taken together, these elements help translate policy ambition into investable projects. Finally, let me touch upon international collaboration, especially how UK and Japan may work together. Japan and the UK, for example, offer highly complementary strengths. The UK has strong experience in market design and financial innovation. Japan, on the other hand, brings strengths in industrial execution and system coordination. There are several areas where collaboration could be particularly valuable. For instance, market design, adapting UK's proven mechanisms to support real economy projects in Japan. For instance, UK has robust cost recovery mechanisms, such as the regulated asset-based model. You have the allowed revenue and the building blocks. We're studying such models and the government support package together that are provided. Secondly, value chain partnerships. So this would include joint ventures in the transition or green projects and offtake arrangements, or even creating a joint supply chain. Third, financial frameworks. This is such as transition finance standards and impact evaluations. And fourth, cross-border investments. We could connect global capital and UK's capital with Japan and Asia's project pipelines. And finally, knowledge sharing, facilitating exchange of best practices and project development know-how. What's working, what's not working. We could learn from each other. These areas together can help expand both the scale and effectiveness of transition efforts. To support this, GXA has recently launched what we call the GXA platform. This serves as an informal network for engaging with a wide range of stakeholders, working as a community. Through this platform, GXA aims to facilitate dialogue across policy, industry, and finance, enable deeper discussion on practical challenges, and contribute to policy development through real-world insights. Importantly, the platform is designed as an open space for candid and practical exchange. This complements more formal policy processes and helps accelerate implementation. Okay. Ultimately, what we're trying to do is quite clear: to bridge the gap between policy ambition and investment reality, and to ensure that transition becomes not just necessary, but investable. It is a shared global challenge we face that could be tackled through international collaboration among various stakeholders. We at GXA hope to make our own contribution by taking a catalyst approach in scaling up transition. Thank you so much for your attention.
Thank you very much for that, Yomori-san. And we have a bunch of slides here that we need to go through. We will get there eventually, just a moment. There you go, that's the slide I wanted. Okay, so with this understanding of how Japan approaches the green transformation, we will now focus on Tokyo. So Mr. Takehiro Sasagawa, so the Director of Comprehensive Global Financial City Strategy at the Tokyo Metropolitan Government, will share how Tokyo approaches sustainable finance and will also outline the groundbreaking Tokyo Resilience Bond. So please. And you have a clicker there for yourself. Thank you.
Thank you. Good afternoon, everyone. I'm Takehiro Sasagawa, working for Tokyo Metropolitan Government. I'm in charge of promoting sustainable finance from Tokyo government. Okay, and today I'm gonna briefly talk about Tokyo's initiatives on sustainable finance. Today's global financial landscape is shifting very rapidly, you know. Investors are no longer just chasing returns. They are demanding market that offer resilience, sustainability, and high growth potential, of course. When we look at Asia, the question is no longer whether to enter, but where to enter. My answer today is very simple, at Tokyo, okay? Tokyo is not just a historic megacity. Remarkably, it sits at the heart of the economy, holding 2,200 trillion yen, which is more than 10.2 trillion pounds in personal financial assets. For decades, this massive capital was a sleeping giant. Now Tokyo is awaking this giant. Under the Tokyo Green Finance Initiative, we are actively orchestrating a shift of this massive capital to fund the transition to net zero future. But how do we achieve this? Entering a new market comes with risks and high upfront costs. This is where Tokyo's strategy is truly unique. Tokyo's greatest differentiator lays in our comprehensive, seamless support system that works with investors every single step of the way. We provide end-to-end assistance across 4 distinct phases, from discovery to attraction, project establishment, and finally to long-term retention. In tandem with this robust support framework, we deploy powerful financial incentives to drastically lower upfront costs. For example, when companies borrow green loans, we provide subsidies to partially cover external review fees and administrative costs. Furthermore, through our primary gateway, Business Development Cost Center Tokyo, BDCT, we have built a one-stop infrastructure that provides total support ranging from complex business operations to daily living needs. Furthermore, Tokyo's momentum has truly taken off since the Asset Management Nation announcement in New York, September 2023. A major milestone achieved in June 2024 was our official designation as a special zone for financial and asset management businesses. This strongly demonstrated Tokyo's commitment to becoming a leading Asian hub for innovation and finance. We are actively transforming our business ecosystem, expanding English language administrative support, and cutting regulatory red tape for asset managers. This is not a plan for the future. This is happening right now. There's a real hungry demand in our markets. When the Tokyo Metropolitan Government issued its own groundbreaking resilience bond last year, they were oversubscribed by up to 7 times by global investors. I will briefly touch upon this later. Now, let's talk about the next frontier and the greatest opportunity, transition finance. Europe has set a strict rule on what qualifies as green. However, Asian economies are deeply reliant on manufacturing and traditional energy. They cannot change overnight. They need a realistic, phased roadmap towards decarbonization. Tokyo is the ultimate gateway for this transition. We fuse capital markets with the industrial and technological expertise, vital to transforming Asian economies. By establishing a base in Tokyo, investors gain direct access to the multi-trillion-dollar transition finance market across the entire Asia-Pacific region. Every great financial center was built by people who looked at the horizon before everyone else did. The next challenges in sustainable finance are scale and talent. And that is exactly where Tokyo is investing next. I believe one of such investments is a collaboration with FinCity Tokyo, FCT. FCT and TMG host dedicated event week, Tokyo Sustainable Finance Week, every fall. These intensive events aim to popularize ESG investing and transition finance while boosting Tokyo's profile as a global financial center. Okay, so let me briefly touch upon Tokyo Resilience Bond last year. This slide shows TMG's recent international bond issuances. On the left side, you can see our 300 million euro 5-year Tokyo Resilience Bond issued in October 2025. This bond is the first resilience bond certified by Climate Bond Initiative as resilience bond. You can see the pie chart on the left that this bond was successfully designated to a diverse and well-balanced group of investors globally. On the right side, you can see our $500 million 5-year bond issued in 2026 April. Despite the volatile market environment following President Trump, the issuance was completed successfully. These deals demonstrate our broad product range and strong presence in international market. This slide provides an overview of the Tokyo Resilience Bond framework. Tokyo Metropolitan Government published its new resilience bond framework and has obtained a second-party opinion from Moody's, confirming that it is aligned with the 4 core components of the ICMA principles. Key features of the framework include, the first one is the proceeds will not be used for refinancing. The second, they will be fully allocated within the current fiscal year. And third one, the reporting will therefore published in the following fiscal year. This slide provides eligible project for the Tokyo Resilience Bond. These projects are part of the Tokyo Resilience Project, specifically addressing climate change adaptation. They consist of 6 projects in total, 3 on the left aimed at flood prevention, and 3 on the right focused on storm protection. As these projects meet the criteria set out in the Climate Bond Resilience Taxonomy, the Tokyo Resilience Bond have obtained the first climate bond certification in the world as a resilience bond. Okay. This is the end of my presentation. Thank you for your time.
Thank you very much, Sasagawa-san. So as our last speaker in the first half of today's event, we're honored to welcome Ms. Vanessa Hayward-Williams, who is the steering group member of the Transition Finance Council.
Hello, everybody. It's really nice to be here. I just wanted to say thank you to GX and FinCity and Nomura for pulling all of this together. I'm always struck by how elegant the Japanese policy structure is on transition finance and transition, in fact. So I'm going to talk to you a bit about what's happening in the UK. I'm talking to you from a market background, and perhaps one of the big differences is that transition finance in the UK has been very much market-led. So I'm going to particularly talk to you about the transition finance guidelines, but let's start a little bit before then. So what's the genesis of the interest in transition finance in the UK? Really, I think it stems from the work that was done under the umbrella of the government, but by private actors, to develop the Transition Plan Task Force Disclosure Framework. And through that, we started engaging really on how to move on a whole of economy basis towards net zero, looking not just at power, which is clearly very important, but also at the other sectors. And after that, the UK commissioned an independent market review, which I chaired, the Transition Finance Market Review, to look at the steps that the UK could take to make the UK a leading global hub for credible transition finance. And we took a whole of market approach. We made a lot of recommendations because it's not the kind of issue where one single solution is sufficient. One of the recommendations was to establish the Transition Finance Council, which was to be the guardian and the market centre of developments of the recommendations where those were market related. There are some that are policy related, there are some that are market related. We report as a council publicly twice a year on how we're getting on with the recommendations and how everyone else is too. And we've also, in our first year, which has just come to an end, produced a number of different outputs, which are market-led. We've produced a finance playbook for sector pathway development. We've produced some policy papers on fiduciary duty and on the use of labelled products. And we've also produced some entity-level transition finance guidelines. But that's not all that's happening in the UK and indeed in the EU. So as well as those things, we've also got other stuff going on in the policy and the market environment. So you will all be very aware that the EU is working on the Sustainable Finance Disclosure Regulation 2.0 and that it has a transition category. We have our own fund categories through the SDR in the UK, which also have capacity to be applied in transition contexts. We have also been doing work, the FCA has been doing work looking at what are the barriers to climate solutions. So how do we enable and build on the innovative culture in the UK and to allow those businesses to scale. And also the Green Finance Institute is in the process of setting up a transition finance lab, which has components that sound very like GX, which is really to allow sandboxing of first-of-a-kind projects and scalable new technologies to allow the market to move in a more agile way. But I was asked to talk about the guidelines, so I will talk about the guidelines. The guidelines are were developed to address concerns that were reported to us when we were doing the review in relation to credibility and integrity of transition finance. There is already some really good work being done at ICMA and the Loan Market Association in relation to particularly use of proceeds labelled finance. The working group at the council perceived that there was a gap in the market in relation to general purpose finance and general investment. And that is actually where a lot of the capital flow is. So we thought that it would be particularly useful to focus in on the type of indicators, the type of criteria that would support the categorization, the qualification of that general finance as transition finance for high-emitting companies who are in the process of transitioning, who have credible transition planning in play. We did it on the basis that it would be country and sector neutral. We did it as a voluntary thing. You can do it, you can not do it, it's entirely up to you. It is another tool in the transition finance toolbox. And because this is a really difficult area, we published as an exposure draft. We are in the process of requesting people to road test what we've produced. We found that the initial road testing we did in the first year was super helpful, and it made us develop a much more succinct set of guidelines. So we will look to refine further once we get feedback from the market. And that should be Q1 next year. So I've talked through a lot of this, but really what we were looking at is creating a set of guidelines that could be used across the market. So a consistent set of expectations that are practical, that acknowledge some of the challenges of transition, but also have a degree of ambition. And that is what we've sought to do. But we're very clear this was not going to be a regulatory requirement, nor in any way compulsory, nor is it a disclosure framework. So we thought that this would, for companies, help anticipate investor expectations, create a more consolidated set of asks, improve access to capital that's interested in the transition. For credit providers, there was an interest in capturing part of their book that they hadn't previously been thinking of in the context of their stated ambitions and their sector targets. It's an ability to inform the development and extend the development of transition finance frameworks, and it supports client analysis and engagement, helps you to understand both the risk and opportunity across the book. And for asset managers and asset owners, there's an opportunity for fund creation, for capital allocation, and to strengthen engagement, both at the corporate level and at a policy level. We were really conscious that this is a busy market and things are changing all the time. So we tried very hard to slot this into the existing ecosystem. We mapped to the IFRS S2, we mapped to CDP as a commonly used disclosure framework, we mapped to the IIGC's net zero investment framework, and we looked at how this could be complementary to fund categories. So we tried really hard, is what I'm saying to you. And in developing our thinking on credibility, we focused on the Paris Agreement as an anchor. We connected to the global average temperature goal of well below 2 degrees. We focused on the upper range rather than the lower range. And we have also encouraged the use of sector pathways and acknowledged that credible corporate pathways may be a blend of multiple different pathways. Our focus has been on science-based approaches, but using all the array of taxonomies, pathways, models that are available. And we have also spent significant time developing new thinking on dependencies. So in this framework, the areas that I think are significant are particularly the flexibility around ambition and how to align to how to develop corporate pathways, the dependency work, and also the focus on financial viability. So this is the structure of the guidelines, which you can find on the City of London website and you can Google. So I'm not going to spend very much time on this, but it's principles-based with principles of ambition, action, accountability, and the acknowledgement and addressing where possible of dependencies, which boil down into categories of factors, which are then further boiled down into 15 core criteria. And there are some recommended criteria that can be applied also, but are not part of the basic process. We also recognize that there's thinking going on, particularly around resilience, nature and biodiversity, and there's also the question of carbon credits and offsetting. So we allow for those to be combined, but we have not, given resourcing, spent time on that. We've just allowed room for that and use of other methodologies in conjunction. So this just maps out what the guidelines start to look like. So we have a number of criteria by factor, and the core criteria are the ones that we expect the assessor to apply. There is a degree of discretion as to when to apply the recommended criteria, and there's also flexibility to qualify if the assessor concludes the principles are met, but there might be some gaps in evidencing particular criteria. I told you that we did some testing. So we did a lot of testing with financial institutions who gave us feedback on how putting portfolios or books through the guidelines worked. And that caused us, if you look at our consultations, to refine and refine and refine. But we also did, and we've published this in an implementation handbook, we did detailed assessments of 3 UK large companies, Anglo, Kier, SSE, showing the workings of going through the criteria and how we concluded what level of sensitivity there was in the analysis. That told us how quickly these are possible to run through. And the answer that we have been given when we found ourselves was that you can get to a fairly quick, relatively secure view as to whether a company is going to meet the criteria or not pretty quickly. We've identified those areas where more subjective judgment is required. And we've also focused on what areas are most likely to be available in public reporting and what you might need to pull from wider web-based resources. And we're looking, because this was UK-led, we're looking to get engagement from other countries. Very conscious that we were a bunch of people sitting in London. And this is an example from the implementation handbook, which also has case studies in advanced markets, in emerging markets. It has guidance on the type of information, the type of proxy information, and the kind of assurance or second-party opinion or climate risk assessments that can be useful or deployed. So you will see from this that we galloped through the first year, which is why my hair is quite as white as it is now. We published in March in Exposure Draft. We will aim to publish a revised version in March 2027-ish. And we would very much welcome engagement from other markets to tell us whether they are interested in applying them because of, or a version or a further iteration or invention of which this is an input. We already have uptake in this market, and we're starting to see the development of fund categories. So, where Japan and the UK could collaborate. This is just my personal suggestions, so take them or don't take them as you wish. It seems to me that we are proceeding along very similar paths. Path is possibly an overuse, but we take a technology and sector pathway approach to transition. And I wonder if there are opportunities to support other markets in going through that system-based approach to transition. I wonder also if, in relation to emerging markets, and particularly project-focused transition finance, there are opportunities to set out the parameters of what is transition finance, what is general finance, and where the boundaries of those might sit. And I think also there is an opportunity to negotiate internationally transition guidelines or transition principles that come from the various different frameworks that are in the market, whether those are yours, ours, ASEAN, OECD, there are a number. Could we perhaps bring things back to a single or fewer numbers of sources? Overall, I think in the UK what we've done is create the market architecture for the London market to lean into transition. That needs a bit of encouragement because the regulatory environment, as I think earlier speakers have said, has focused more on defining green, but we now need to create the supply for all of this green power. And that gives us all also an opportunity to collaborate, because I completely agree that we are all in this together and we need to make progress, as outside demonstrates, quite quickly. So thank you very, very much.
And now, coffee break. So, with that, we have reached the end of the first half, and it's time for a short coffee break and a leg stretch before we reconvene at 14:50, 10 to 3 for the panel discussions. So, hope you've enjoyed the discussions so far, and that the insights have been valuable, and we will reconvene again after the coffee break. Thank you very much.